Welcome back, everyone. I hope you're having a great day. And in this episode, we're going to take a look at the major dividend increases that were just announced from the largest banks within North America. 5 of the 6 big US banks announced a massive dividend increase over the past trading session. And just last week, the Fed removed their restrictions on dividend increases in all the major banks because they passed the latest stress test, were allowed to grow their annual dividend payout. And on Monday, we were not disappointed. 5 of the big 6 banks announced double or even triple digit increases to their annual dividend, and they have plans to return tens of billions of dollars worth of capital to their shareholders over the next few years. And going forward, the Fed has now removed the restrictions on dividend increases and share buybacks, so the companies have a lot more flexibility on when and how they want to return capital to their shareholders. And going forward, as long as all the big banks remain above a certain capital restriction, they can do pretty much whatever they want in terms of dividend increases and share buybacks. So overall, in this episode, we're going to break down how much each of the big banks increased their dividend and the share buyback plans going forward throughout 2021 and into 2022. But before we do that, I'm going to ask you to please hit that like button and subscribe. I'm the Gen Z investor, and every single day we talk about the stock market, going over different stocks you can buy and any major market news. So please hit that like button, subscribe for the daily videos, and of course today, we're going to take a look at the massive growth in passive income that the big banks just provided to their shareholders, which is a great sign to see. So of course, when the pandemic started, we thought we were entering into another major financial crisis. People were expecting the banks to go down, they were putting away tens of billions of dollars in loan loss reserves, but after we got through this pandemic, the worst did not come, which is a great sign. And leading the way after the restriction was lifted is Morgan Stanley. The big investment bank doubled its quarterly dividend. They doubled it. A 100% dividend increase is absolutely insane. Morgan Stanley, who trades under ticker MS, has doubled their dividend payment to 70 cents per quarter from the original 35. So the massive dividend growth absolutely crushed Wall Street's expectations, and the optimistic street estimate was for a dividend increase to 55 cents. But of course, Morgan Stanley came in, absolutely destroyed that number, and increased it all the way to 70, doubling the original amount, and now the annualized dividend yield on the company now sits at 3.2%. So going forward, I think this makes Morgan Stanley one of the more attractive banks on the market. They are actually one of the highest yielding with over 3% right now, and even after the massive run-up, I think Morgan Stanley may be a nice addition to a portfolio for some nice growing passive income. And if we take a look at the second big bank who had a major dividend increase, it is Wells Fargo. So of course, this company actually doubled their dividend as well to now 20 cents per share per quarter. And they also announced $18 billion of stock buyback over the next 12 months. But one thing to take into consideration, that when the Fed did their initial stress test, Wells Fargo was forced to slash their dividend. They cut their quarterly dividend from 51 cents all the way down to 10 cents during 2020. So the fact that the company has now doubled their dividend and brought it back up to 20 cents per share per quarter may sound like a great headline, but it's still less than half of where it was pre-pandemic. So I think in terms of dividend position, Wells Fargo is lagging behind the competition of the major big 6 banks. But this company is emphasizing major share buybacks. Of course, they announced another $18 billion, and that's what they're focusing on going forward over the next 12 months. And the company also has plans to return around 10% of their current market value to the shareholders within the next year. And if we take a look at Wells Fargo's stock chart, they currently trade for $45 per share. They're up close to 70% over the past year, and they have a current market cap just below $192 billion. So if we take into consideration the $18 billion worth of share buybacks and a couple $1 billion for their annual dividend, they can return over $20 billion of capital to their investors over the next 12 months, which makes up more than 10% of the current market cap of the entire company. So they are returning a ton of capital to their investors, which is a great sign. And now if we move on to bank number 3, we have the other key investment bank in Goldman Sachs. Ticker GS has announced a massive dividend increase as well by 60% and will now pay out $2 per share per quarter going forward throughout 2021 and beyond. This is an increase from the $1.25 per share per quarter they were previously paying out, representing 60% growth from the major investment bank. And going forward, the current yield will now be increased to 2.2%, which is again very attractive for the banks after the major run-up. And if we take a look at Goldman Sachs, the company has absolutely exploded as of late, growing by 78% on the 1-year chart. And the company has a current market cap at $131 billion, and they're trading with a very low forward PE ratio of only 8.18. So overall, Goldman Sachs had the third largest dividend increase on the day, growing their annual payment by 60%. Of course, that is lagging behind Morgan Stanley, who grew their dividend by 100%, but it is great to see some massive dividend growth coming from the large investment bank. And then coming in number 4, the largest US bank in terms of assets and market cap is JPMorgan Chase, and they increased their dividend to $1 per share per quarter, up from the 90 cents it was previously sitting at. And now at $154 per share, it has a current yield of 2.6%. And the dividend increase to $1 even is exactly what Wall Street was predicting and represents a growth rate of 11% year over year. So JPMorgan Chase, if we take a look at the company's stock chart, currently sits at $154. They're up by 57% over the past year, and they have a current market cap at $466 billion. And this is a company I have recently bought in my personal financial freedom portfolio. And I just released a video a few days ago outlining my perspective on the company and my bullish thesis going forward. And right now, after that latest buy, I now own 35 shares of JPM with a market value of $5,400, and I'm up around 22% on my total position. And this is a company I plan to own for the long term. I have no intention of ever selling out of JP Morgan right now, and I think this company will return a ton of capital to me in the form of growing share buybacks and a fast expanding dividend. So this company grew their payment 11% today, which is a great sign. And now if we move on, the next bank is Bank of America, and they increased their payout 17% to 21 cents per share per quarter, which was in line with Wall Street expectations. And after this increase, the company will now have a current yield of 2%. And there's one very famous investor who I believe was very happy today when he got the news of the 17% dividend increase from Bank of America. And that is the GOAT Warren Buffett, one of the greatest investors of all time, the CEO of Berkshire Hathaway, and his company is a very key shareholder within Bank of America. And if we take a look at his portfolio, BAC is the second largest holding. Just behind Apple, Bank of America is the second largest holding within Berkshire Hathaway's total portfolio. He owns more than 1 billion shares of the company, and the total market value of his position now sits at just below $43 billion, and he owns 12.1% of the company. Berkshire Hathaway and Warren Buffett own 12.1% of Bank of America. So they collect a ton of dividends from this company year after year, and this dividend increase is going to add a ton of cash flow into Berkshire Hathaway as well. So Bank of America and this increase, I believe, will make Warren Buffett very happy, which is a great sign for the Oracle of Omaha. And now moving on to the next bank, this is the one that did not raise their dividend, and that is Citigroup. Ticker C put out a statement saying that the company is looking forward to continuing with our planned capital actions, including a common dividend of at least 51 cents per share. The current payout they're doing right now is at 51 cents. And analysts were expecting a new dividend of 54 cents, but that of course did not come true. So they're the only bank of the top 6 that did not raise their dividend. And all the other companies did a double or triple digit dividend increase. So a little bit of a shock that Citigroup didn't even do a minor increase to kind of keep up with the competitors. And after the Fed test last week, all the major banks are in a very strong financial position. And a top Wall Street analyst was quoted as saying, "This is a new day for the banks. It reflects some of the strongest balance sheets we've seen in a generation. And going forward, new investors may be attracted to these companies because of the increased dividend security and a combination of the dividend and major share buybacks. And this could actually lead to an annualized yield around 8%, which is much better than the junky bonds you can find on the market that sit around 5% right now. So the total cash distribution plus the share buybacks, so the total capital return to investors year after year could average around 8% amongst the big banks, which is absolutely incredible. And many of the big banks are expected to turn 100% or more of their earnings in stock buybacks and dividends within the next 12 months. So that means 100% or more of their recent earnings are being brought back to the shareholder, which is absolutely insane. So overall, I think the big banks are in a very strong position. Financially, like we've seen, they're in a very strong place, and going forward, now that these companies have a lot more flexibility to repurchase stock under their own rules and increase their dividend without having to seek approval individually, as long as these companies stick above a specific capital requirement, which I do believe they will all do with ease, the companies have a lot more flexibility to do what they want, which I think is great to be a bank shareholder at this current point in time. And if we jump over to my personal dividend portfolio spreadsheet, we can see I'm a big player in financials. I always have been. I was a major bank shareholder before the pandemic, and even at the lows throughout the pandemic, I bought more banks. When everyone was selling out of the banks, I bought even more and actually bought a few Bank of America shares during the lows back in March and April in 2020. So if we take a look at my current portfolio, I own 4 key banks. I have JPMorgan Chase, Bank of America, Royal Bank of Canada, and Toronto Dominion Bank. And I also own BlackRock as well as a big player in the financial sector, but I do not consider them a big bank. So if we take a look at the top 4, JPMorgan Chase and Bank of America are the 2 largest US banks in terms of assets and market cap, which is why I chose those 2, and I've been building up those positions over the past few years. Then I have Royal Bank of Canada and Toronto Dominion Bank, which, similar to JPM and BAC, they're the top 2 players within Canada. And if you're unaware, Canada has a very strong financial system. For a smaller company in terms of market size compared to the United States, their financial sector is extremely strong. The banks dominate the entire country and provide a ton of great capital returns to their shareholders, and they've been doing so for a very long time. And to give some perspective, through the 2008-2009 financial crisis, when all the American banks had to slash their dividend, the Canadian banks maintained their current payout throughout all of the tough times, and they have not cut their dividend in over 50 plus years, which is extremely impressive. And if we take a look overall in my portfolio, the financial sector is my 3rd largest sector. First, of course, is tech, making up around 44% of my portfolio. Then I have some consumer staples, making up 14.4%. And then third is financials, making up 13.9% or over $15,000 of my overall financial freedom portfolio. So I'm a big bull on the sector. I put my money where my mouth is, and I own 5 main companies overall with over 13 to 14% of my allocation within my entire financial freedom portfolio. So overall, those are the 4 big banks I own in my personal portfolio. I will hold them long term, collect the 4+% yield on costs I have, and continue to watch my capital appreciate through the form of share buybacks. So overall, in this episode, we took a look at the big 6 banks and all their recent dividend increases. 5 of the 6 put out a nice payout in the double or triple digit range. And going forward, I think the financial sector is going to do very well. I think they'll continue to grow, and I think the banks are in a very strong financial position. So now we're going to wrap up the video. I want to thank you for watching all the way to the end. Please hit that like button and subscribe if you already haven't done so, and I will see you in tomorrow's episode.